everybody, Ben Nelson, the Everyday Real Estate Investor here. Hope you are doing well. Hey, it's been a little bit since I put out a podcast, just lots going on in life and everything. So thanks for bearing with me. But man, we are getting to the end of the year here. It is there's a lot going on in the market right now, so it is definitely appropriate to do a update here with Grant Schroeder, Academy Mortgage, who we have back on the show. Let's talk about the market and what's going on. Grant, thanks for being here.
Thank you for having me, Ben.
Awesome. Well, let's dive right in. So, nothing's really happening right now. Lots happening in the interest rate world. Maybe some good news, light at the end of the tunnel per se. And so let's talk about that. Talk about a little bit about the Fed and what's happened there in the last week or so, and how that's affected rates, and then we'll go from there.
We're recording this on Thursday the 14th, and this has been one of the best weeks we've had in almost 2 years as far as mortgage rates go. Fed Chair Powell got up on the podium, and he was dovish for the first time in 18 months. So I don't know if we've talked much about those terms, but for the last 18 months, the Federal Reserve has been very hawkish. So you hear the terms hawkish and dovish, and hawkish is typically more focused on tightening restrictive policy, hiking the Fed funds rate, reducing their balance sheet, where dovish is almost more optimistic. They're loosening policy, potentially lowering the Fed funds rate, starting to buy mortgage-backed securities, that sort of thing. So they've been very hawkish, especially the last 3 months, doubled down on it, and that's where we saw mortgage rates jump to over 8%, and the 10-year Treasury hit 5%. I mean, we just dipped under 4% this week with the 10-year Treasury, so that was really encouraging.
Yeah, and that's, you'd say, you just said over the last few months they've been more hawkish, and so that's a pretty, seemingly quick kind of flip there.
Yeah.
Maybe it's just part of how they position themselves up there, and when they're doing these things, and they knew that that's what they were going to do, and it's just part of the strategy. But it could be they saw some things, and that's what caused them to switch rather quickly, seemingly, right?
Yeah, it doesn't seem like it's been gradual at all. It's been a flip of the switch, because Powell would come out and say something, and the markets would react in the past couple months, and he'd say the opposite and be more hawkish in tone, like they were waiting for something. And we definitely saw that with the jobs numbers the last 2 months. We've been talking about that, where there are cracks, but they're not hitting the headlines, or they're not trickling in until 3 months later when revisions come on some of those jobs reports. But the headlines finally started to show it. The job openings data, those cracks are starting to show in the economy. It's like, okay, we need to step back and stop tightening. He didn't take recession off the table in his comments yesterday, but he definitely signaled the end of the tightening cycle, and said they are open to doing rate cuts. Their dot plots, which forecast the rate cuts for the next 3-4 years, was showing at least 3, potentially 4, based on a poll of the 18 Federal Reserve members that were in the meeting, and they were all showing 3 to 4 cuts just in 2024. So
yeah, interesting.
That's encouraging.
Which is, I think, what we had talked about a year ago, happening this year. And we were. I won't say we were wrong, but okay, we were wrong. So hopefully, we're just a year behind. That's all. That's what we thought would happen. So
there were some unforeseen factors there.
Yeah.
With the banking crisis threw everyone for a loop, and you had several banks fail, and everyone thought with inflation coming down the way it has that we'd see mortgage rates improve
sooner.
But
so let's talk about, because we've talked about, for those that haven't listened before, the quasi connection between Fed funds rate and interest rates, right? They're not necessarily a direct correlation, but there's a relation there, right? So let's touch on that, and then along with that, let's maybe talk about, looking forward. We've talked about rates are actually higher than the margin's higher than it normally would be, and so we've got 2 things happening right now that potentially could be pulling rates down. We've probably got what's going on with the Fed, and we've got markets kind of leveling out, and then with that so that's going to bring rates down, and then we've also got as things stabilize more, that margin will shrink as well. So we've actually got two things. We've had two things kind of pushing the other way.
Yes.
So now we've got the opposite effect where we're
Yeah.
going to have both of those things working in the favor of interest rates. So I think I just gave it all away, but no, I'm just kidding. Yeah, if you can expound on that. Yeah.
Yeah, of course. So the Fed, I mean, they're a dual mandate Fed, so they're in charge of full employment in the economy, but also not letting inflation get out of the way, which that happened in the past couple of years. But the Fed funds rate is one of the levers they control. And so when they hike the Fed funds rate, that is affecting things like home equity lines of credit, consumer credit. So home equity lines of credit, credit cards, student loans, variable auto loans, that sort of thing. It's not directly tied to mortgage rates. Mortgage rates are bought and sold, securitized in the mortgage-backed securities market. So just like the stock market, it's a bond market that's fluctuating every single day. Even though they're bought and mortgages are bought and sold in the mortgage-backed securities market, most commonly a correlation is drawn with the 10-year treasury because it's positive. So when the mortgage-backed securities market, like right now, it is rallying, we're seeing mortgage rates go down. There's an inverse relationship. So a lot of people draw a common relationship between the 10-year treasury because when it drops, mortgage rates are also dropping. So it's a positive correlation. Because of all the uncertainty, you've seen secondary investors and lenders create more margin due to refinance risk, due to uncertainty in the economy. So normally the spread between the 10-year treasury and mortgage rates on a 30-year fixed conventional loan are 180 to 200 basis points on average historically. We've been at 300 basis points or 3% the last really year and a half.
So it's another one. So if you look at, so you say interest rate is at 7%. Historically, with normal margins, it would be 6%, right? But there's an extra 1% kind of baked in there, right? Yeah.
One of the other things, so you don't have to see the Federal Reserve cut the Fed funds rate. The futures markets are already beginning to price those rate cuts in, but just the amount of like, hey, they're giving some direction on where we're going or where they want to see the economy go, which has not been the case the last 18 months. They typically use a lot of Fed speak and jargon that sounds official, but it's interpreted multiple different ways by the media and the markets. But giving more certainty, you could see mortgage rates begin to compress that margin and get closer to that 200 basis point spread without them ever having to cut the Fed funds rate until middle of next year, potentially. So that's very encouraging. It's some of the best news we've had in 18 months, and certainly a good Christmas present as we
Merry Christmas. Here's some lower mortgage rates coming our way, right? Awesome, yeah. So let's talk a little bit about how that is going to affect this market moving forward from a like activity and prices and that sort of standpoint. So we've seen so here in Portland, we were just talking about before we got on the show here, like inventory in the sense of like number of homes on the market is pretty much the same as it was, this time last year. It really hasn't changed. Inventory from a absorption standpoint has gone up. And that's just, because it's more expensive, right? With the mortgage, less people can qualify. People are maybe waiting some things out. But it's what was it, 3.6 months of inventory, something like that for those who would have been November numbers. So it'd probably be over
in December,
right? I mean, like, and so historically, we've what for years we had 0.8, 0.9. Maybe it will get to like 1.3 or 1.4 in December.
We haven't gotten much above 2 months supply in the last 2-3 years. Since
So
2020.
It seems like a lot. It's really not that much. It's edging towards more of an equilibrium market, but that's with rates being kind of a factor with people being either hesitant or unable to afford it. So we just talked about interest rates coming back down. What do you think in the market's going to look like here in this spring? We're going to get out of the spring market or the winter market, get past the holidays where everybody's like, no one's thinking about buying a house right now anyway, right? Yeah. They're thinking about I got to finish my Christmas shopping. It's only a week or so away.
There's definitely a slower moving pace of life right now, lack of a sense of urgency. That's normal around the holidays. The higher rates kind of compounded that.
Yeah, for sure. Yeah.
But I mean, seeing that we hit 8.25 for 30-year conventional mortgage, someone put 25% down.
Yeah. And what were they today?
They were at 6.65. 30. That's like 30-year fixed, 25% down, 780 credit, like the optimal buyer profile.
Yeah.
So it's going to vary by situation, but that's really encouraging. That's kind of the benchmark. But to see, I mean, we've already seen an uptick the last 3 weeks in applications, people starting to see more positive headlines. I mean, for over the last 45 days, we are now down 1.5%.
Mm-hmm. That's a lot. That's a huge, we thought that went up quickly. They went about, I think it was about that quickly they went up when they first started going up. So now we're going the other way, right? So what is that going to do for demand? I mean, I'm just wondering.
Typically, the number of applications, the uptick we're seeing is a forward-looking indicator. So you're looking at people that are going to be buying in the next 30, 60, 90 days. Yep. What I've been talking with a lot of buyers, whether they're first-time home buyers or moving up, there's going to be a small window of opportunity in Q1 and Q2. If we stay on the same rate trajectory, granted last year at this time we were moving from the low 7s, we moved down to like top of the 5s come January of this year. But when the banking crisis hit in February, we quickly jumped up another percent in mortgage rates. That was something that wasn't foreseen.
Right. Yeah.
But you have the buyers that can qualify for more. Like I had someone that's been struggling, their capped debt to income ratio, looking to buy a home. They've been in the mid 7s, high 7s, or put 5% down. And I sent them numbers today at 6.625, and there's like DTI at that price point. Like their payment, even though it's only like a $300,000 loan, their payment was different by $350 a month, and they weren't capped at that same price point they'd been just a couple months prior. Mm-hmm. So that's really encouraging. But also the fact that someone can do a 2-1 buy down now, you get into the 4s to start. Where you're in the 8s, getting down to 6s.
Yeah, that's a little bit of a difference. Yeah,
but just people, so much.
God, I'm glad you mentioned. That's a huge difference. Yeah, we can actually do a buy down and get in the 4s now. Yeah, that's crazy. Okay.
So much of our, I feel like the last 4 months in our industry is trying to dispel the negative headlines, because so much of it's the worst time ever to buy a home, and it's like, this is perfect. Yeah. You're one-on-one with a seller. You have prime negotiating power to get seller credit, to get a price reduction. You're buying a home now, not facing 2, 3, 4 other offers of competition, pushing the price higher.
I know, yeah.
Mortgage rates are dropping. You can take advantage of that before the general public catches up.
Let's just squash this right now, okay? If you're waiting for a market that has 3 to 4% interest rates, where you have, your pick of a house, and you can go and take your time looking at your home you're going to buy, your investment opportunity, whatever. You have leverage with the seller. You have time to sit there and negotiate. Keep waiting, right? I mean, that's just not going to happen. There's no, you want, as a buyer, like markets, that's just how markets work, and you're never going to have this perfect market to buy in. Something is going to be off kilter, right? Mm-hmm. But you can use whatever piece that is to your advantage, right? So interest rates have been higher. Well, yeah, but that means now I have the opportunity to go negotiate a little bit and spend some time looking and actually talk to a seller and be one-on-one and be the one offer. Before it was like, oh yeah, I can get a 3% interest rate. Yeah, but good luck. Yeah. You're one of 20 offers. Yeah. So like, which one do you want? I would rather, if you're thinking long-term, absolutely right now is way better than, being in price, bidding wars and just for a lower rate. I mean, people get so fixated on rate, and they forget about all the other stuff, right? So that's
focus on a monthly payment that you can afford, which you can qualify for.
Yeah. I was going to say it is an important factor, especially for your personal residence, but
don't fixate on the rate.
Yeah, exactly. Yeah. So we have inventory that really isn't any higher. Mm-hmm. It's higher only because of absorption. Yeah. We have a super low. We have a shortage of housing by a lot still. Builders slow down a little bit because uncertainty, and their funding got more expensive,
builder confidence has
dropped,
builder
confidence drops, right?
Slowed the pace of building. From
it's a lot harder.
Permit to completion.
Yep, exactly. Yeah, and then you've got pent up demand because people still want to buy, right? You've got people that were maybe waiting it out. You've got people that wanted to do a trade, but it didn't make sense to go from a 3.5 to an 8. Well, it might make more sense at 5.5, or if you can do a buy down and get in the 4, and now it totally makes sense. Okay, yeah, I'm at a higher rate, but it's not by that much. Now they're coming back on the market, right? And all these people that have been kind of sitting on the sidelines waiting, they're going to be coming back to the market here. And I think that inventory is going to go from 4 months or whatever it's going to be in December. I mean, again, this is Portland.
Yeah.
I think we're down under 2.
Oh yeah, the supply and demand imbalance is a recipe for more appreciation next year. I think there's a small window of opportunity for buyers in Q1 and Q2 trying to get in, maybe still get some seller credit, be one-on-one with a seller before people really start to jump into the market. You have so many, whether it's a first-time home buyer that's an affordability issue, that can't qualify for something, or it's a move-up buyer, someone that is stuck between, okay, I have these golden handcuffs of a 2 or 3% mortgage rate. I don't want to leave that house. We've been having a lot of conversations with sellers where, okay, you can do a home equity line of credit if you need to access your equity, fix up the home to sell, or if you want to keep the home as a rental and kind of become an accidental landlord and move up to the next home, but you still want to tap some of that equity doing a fixed home equity loan, not touching your first mortgage at a low interest rate, making sure that there's still cash flows when you're leaving. But that's a conversation we're constantly having with sellers, and rates dropping is making that jump to yes, they're taking on a little bit higher payment maybe than they've had at a 2 or 3% rate, but that is becoming more comfortable, more natural, because
to keep
household family sizes have grown. People have been having children. You've had a lot more families combining or household growth. People are ready to move, but they've been waiting to do so with rates and affordability where it's at.
So I'm sorry. So you're saying those conversations are to do that still? To keep because they still have a 3%, 3.5%, whatever, right?
Correct.
So taking some of their equity as a second loan, and then now when rates are down, going out and buying something else. Is that, am I understanding that right?
Just trying to educate people on what their options are.
Yeah.
If they don't want to give up the interest rate, but they want the larger home, their family's grown, so maybe they rent it out. I mean, if they don't like the landlord experience, they still have 3 years to sell it without paying capital gains tax if they've lived in it 2 of the last 5 years. So it's
kind of risk.
Hey, it's
test it out. Yeah. And by the way, what does that not do if people decide to do that? It doesn't add more inventory.
Inventory. Yes. First time
home
buyers
another buyer taking inventory.
Yep.
And you have no new inventory coming to the market. So that's. I mean, that'd be an interesting thing to see how that plays out, because I mean, if a lot of people take advantage of that, I mean, it adds rental inventory, but it doesn't add housing inventory for purchase. So, that'd be, we'll see how that plays out.
Supply and demand. I mean, we've seen that mortgage rates hitting 8% did not cause the housing market to crash,
right?
Where people were screaming for it a year ago when we hit 7% rates. Rates are not going to be they affect affordability. They drive down demand, but supply and demand is going to be the driving factor for the next several years, if not more, because we're so underbuilt in the U.S. for the last decade. Yeah, and I would say that's the part that I think we were wrong about interest rates and when they would come back down. But I think we were 100% right about that aspect, that we were not afraid of interest rates. The results once they do come down.
Yeah, we're not afraid of interest rates causing a housing market crash. And I think my caveat to that was, like, there's a breaking point at some point, right? Yeah. Where was it? I don't know. Hopefully we're not going to find that out. It doesn't look that way, but at a certain point it's like, okay, maybe we got to 10 or 12 or whatever that threshold was, but now we're headed back the other way, and like we've been saying, those floodgates are going to open back up, and lots of people that have been in the industry for a long time have been saying this for months and months, and for the whole year, basically. Like, okay, this is where we're at now, but just wait.
Now is the time
just
to
wait.
buy a home. There's a small window of opportunity before you start facing competition.
Yeah, just wait, or don't just wait. Buy now. Yeah, they're saying don't wait, right? Yeah.
Buy now, something you can afford. You're going to have an opportunity to refinance in the next year and a half.
Yeah.
You can get seller credit, cover your closing costs when you purchase. because you're going to have closing costs. You can wrap them into your mortgage when you refinance, but you are refinancing a home, an asset that you already own, instead of competing with 3, 4, 5 other offers if you were trying to buy at that time.
Right.
So
Yeah,
we've done
absolutely.
many comparisons with, buying a home at $500,000 now at a 7% rate versus, waiting a year and a half, 2 years, buying at a 5% rate, but now the home is $550,000, and you've refinanced to that 5% rate. Your equity savings, your monthly payment, it doesn't even compare.
Yeah. Yeah, and this, I mean, there's a lot we could get into here. I just remember some of the things I just was seeing out there that are just like, it doesn't work that way. But people listen to it, right? Where, okay, well, if rates are 3%, here's your payment, and if rates are this, to basically the rate's this, the payment has to stay the same, so this is what the price has to be, those kinds of things, right? You probably saw some of those out there, right? Where it's like, well, the payment was $2,500 a month, and if the rate's this, the payment's $2,500 a month, but the price has to be this for that payment. Well, okay. But that doesn't mean anything. Anyway, yeah, it just drives me nuts. So,
a lot of misinformation.
yeah, and people, just because something happened, again, we said that too, just because something happened one way one time, back in the financial crisis, which was, by the way, the exception.
But it's fresh on everyone's minds.
Right, even though it was
that's where people's fears go.
almost 20 years ago, which is crazy, but 15 years ago.
With a completely
Believe that?
different supply and demand
Yes,
and
absolutely.
lending guideline.
Way
balance
different,
whatsoever.
yeah, and I think that's the other thing too, is that lending has remained fairly readily available. Yeah, it's not been loose to the point where it was pre-financial crisis, which is great.
Yeah.
That's actually good, and it's been less affordable, but it's still been available to those that can afford it and qualify. Whereas back during the financial, they shut the spigots off.
Yeah.
And you could have a perfect credit score and 20% debt, and they still wouldn't lend. I mean, they're just there was no funding available, basically. So, we just never.
That hindered the recovery.
Absolutely.
Out of the financial crisis.
Absolutely, yeah, because there's supply and demand is one thing, capacity to pay is a totally different thing. And part of that is affordability, and part of that is available of funding, right? So, yeah, you take away the availability to go get a loan, and of course the market's going to crash because only people with cash can buy it.
Yeah.
Right. So yeah, absolutely. Well, awesome. Yeah. I mean, I feel pretty good about 2024.
Yeah.
I felt good about 2023. 2023 was a little bit different than I anticipated in a lot of ways, but 2024 is going to be, I think, a good year for housing. And if you're out there on the fence, get off the fence. Go buy something.
Very encouraging. I'm very optimistic about 2024, what's to come. Some of the different economists I'm listening to, what they're seeing. I mean, just the 180 that the Federal Reserve has done. Unfortunately, they control so much of the economy and downstream effects with their policy. So it's encouraging to see them. It seems like turn the corner. I mean, we'll see what they say next week.
Yeah, it is.
The markets are certainly seeing it right now. So
yeah, absolutely. Yeah, no, I'm optimistic. I think. What's our rate prediction for let's say summer market? We're gonna be wrong because we were last time, but
I mean, right now, my thought process, we've come down very quickly right now.
Yeah.
And there's always some profit taking that goes on.
I'm gonna say 5 and 5/8. I'm just throwing it out there.
I mean, I've always thought kind of mid-6s was where we'd be midsummer. Maybe 6.375 to 6.5 at best. I mean, we're sitting at 6.625 right now.
Optimistic then is what you're saying.
I think
if
a
we're
month or two ago,
we're mid-5s, that it's gonna get crazy.
5s in 2024 would be crazy. I've always thought that 5s would be a little bit wishful thinking.
Yeah.
That's probably more of a 2025 premise.
Yeah.
But with how quickly, I was listening to Brian Buffini the other day, it's like how quickly rates moved up, they could very easily lower that just as quick, especially with margin compression. So,
exactly.
I'm planning around being in the mid-6s. Again, stability is what we want to see.
Yeah.
If people know their payment. They're not 6.99 when they apply and 8% when they go to find a house.
Yeah,
15, 20 days later.
Yeah.
But if we're stable between 6 and 6.5, awesome. I mean, people can buy into the 5s right now if they really want to. But
exactly, yeah.
It gives
which, by the way, is a good rate. I mean,
5s and 6 are going to be more of a normal for the next several years. I don't know if we'll see 3% in our lifetime. People will be able to buy into the 4s at some point, probably 2025, 2026. I think that's a real possibility, but there would have to be something incredibly wrong with the global economy, the U.S. economy, to see us back in a 3% and 2% rate. The Federal Reserve would have, they were subsidizing that, buying mortgage-backed securities.
Yeah, and I think that's what people don't understand is that, like, it wasn't a good thing that we were
artificial
rate. Yeah, it was good if you got a mortgage at that rate and you locked it in, but for the economy and for overall stability, I mean, that's why we're here, and that's why we've gone through, because they did that, and they did it for, in my opinion, being not as smart as them apparently, way too long. Before even COVID hit, I was like, why are we still on these rates? And then they lowered even more to offset all of that stuff. So,
and then we introduced inflation.
Yeah. So it really needed to happen like years ago, where they started, like, you didn't need to go crazy, but they needed to start,
They tend to pivot late and overdo it whichever direction they go. And so I don't know if that's kind of why we've seen this feels like a sharp pivot just in this week, but hopefully the course for them looks more dovish.
What happens when you pull those levers is it's not as steady. The economy does more of this, right? The up and down and larger swings versus
even if they didn't cut rates immediately. Like, I've seen some of the futures markets price in as soon as their March meeting. There's a high optimism that that's going to happen, but even if they didn't, just the fact they've signaled they're done hiking, done tightening, the markets are really loving that. The fact that if they just let things be, because they've talked about higher for longer. I honestly, they don't need to cut rates immediately, but just keeping things, shooting for that stability, letting the economy kind of run its own course, not feeling like they have to tinker all the time.
Yeah. But they have too much fun doing it. They have too much fun. I'm optimistic. Appreciate you being on the show, Grant. We'll definitely have you on throughout next year, just to make sure that we let everybody know that we were right. No, I'm just kidding. Hey, this stuff it's been more exciting this last couple of years, I guess, to have these updates, because everything just has continued to change.
Economics.
We would have done this a few years ago. I'd have been like, okay, what are we talking about? Rates are still 3.5%. Like, okay.
Economics and the market are typically boring, and that's kind of the way we like it. But it's been incredibly exciting the past year and a half.
Yeah, and it gives us something to talk about. So I will take a little break though. It will be for some stability. I'd be okay with for a while. So awesome. Well, thanks again for being on the show. We'll have you on again soon. If you didn't get anything from the show other than get off the fence and go buy something, okay, right?
That sounds like a plan to me.
To do it.
Thanks for having me on.
Awesome.
I always enjoy it.
Yeah, thank you.